The trade war between China and the United States is often described as a battle for global economic dominance. Tariffs, sanctions, and supply chain disruptions have made headlines for years. But behind the political statements and media noise, one important question remains. Who is actually winning this trade war? To understand this, we must look beyond slogans and focus on economic facts. The conflict began when the United States accused China of unfair trade practices. These included intellectual property theft, forced technology transfers, and heavy state subsidies to Chinese industries. In response, the US imposed tariffs on hundreds of billions of dollars worth of Chinese goods. China quickly retaliated with its own tariffs on American exports. At first glance, it looked like a direct confrontation. But the real effects were more complex. The United States entered the trade war with a major advantage: market size. The US economy is larger and more diversified than China's export-driven model. American policymakers believed that China, which relies heavily on exports, would suffer more from restricted access to the US market. In some ways, that assumption proved correct. Chinese exports to the US slowed, foreign investment became more cautious, and manufacturing confidence weakened. Many multinational companies began shifting parts of their supply chains out of China to countries like Vietnam, India, and Mexico. This reduced China's dominance in low-cost manufacturing. However, the story does not end there. China adapted quickly. Instead of relying only on the US market, it expanded trade with Asia, the Middle East, Africa, and Latin America. Chinese exports to Southeast Asia increased, and regional trade agreements helped soften the blow from US tariffs. At the same time, China invested heavily in domestic technology, aiming to reduce its dependence on American chips, software, and components. Now let's look at the American side. While tariffs were meant to protect US industries, they also increased costs for American businesses and consumers. Importers paid higher prices for raw materials and components. These costs were often passed on to consumers in the form of higher prices. Several studies showed that US households bore a significant portion of the tariff burden. American farmers were another major casualty. China reduced its purchases of US agricultural products, particularly soybeans. To offset the losses, the US government had to provide billions of dollars in subsidies to farmers, effectively shifting the cost of the trade war to taxpayers. So, did the US gain anything? Yes, but with limits. The trade war brought attention to national security concerns, especially in technology and critical supply chains. The US strengthened restrictions on advanced chips, artificial intelligence tools, and sensitive technologies. This slowed China's access to cutting-edge innovation and protected some strategic industries. However, these controls also pushed China to accelerate its own research and development. Instead of stopping China's progress, they encouraged long-term self-reliance. In reality, neither side achieved a clear victory. The United States demonstrated its power by using access to its market as leverage. China showed resilience by adjusting trade routes and investing in independence. Global supply chains became more fragmented, and businesses worldwide faced higher uncertainty. Perhaps the biggest loser in this conflict is the global economy itself. Trade wars reduce efficiency, raise costs, and increase inflation. They create uncertainty for investors and slow global growth. Rather than a zero-sum game, the U.S.-China trade war revealed how deeply interconnected modern economies are. So who is actually winning? In the short term, the United States holds more leverage due to its market size and financial power. In the long term, China's ability to adapt and diversify means it is far from defeated. The truth is simple. There are no real winners in a prolonged trade war, only shared costs.